I wouldn't say this with the propane because it's a very genuine impact, but I guess some of the geopolitical rallies and some of the kind of, the oil market's moving because of this, and then someone picks up the phone and starts buying because of something random, that is dumb money. Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive of Onyx Capital Group, joined today again with Martha Dowding and Vincent Wu on the research team. Just a quick reminder, please follow us on YouTube, Spotify, wherever you get your podcasts. Really makes a big difference. And I hope you caught the latest kind of special episode. It was Women in Leadership. And we'll kind of be continuing this theme of, this is the core podcast and kind of special podcasts around it. But guys, just to get straight into it then from a market side, Vincent, do you want to give us an overview?
So it was a very bearish week in crude, not only the flat price but also the Brent expiry yesterday as well. Since we recorded our podcast last week, flat price went south of $90. Very, very bearish tone as the market was sort of fatigued about the geopolitical risk narrative. And despite escalations over the weekend with Israel properly commencing its ground invasion, ground operations, the fact that their invasion in Gaza has remained limited without seeing the risk, without so much risk of a regional escalation or spillover. Price action has been very much muted and down into the mid-80s this week. So which has and flat prices since that range bound at that level. At the same time, there's weak economic data out of China, out of the Eurozone, and it seems that crude is just having a very bearish tone going towards the end of the year, and the bullish hype is well and truly over.
You think it's well and truly over? I like what you said before previous podcasts. It's probably going to be just less bullish.
Less bullish.
We are still in an OPEC cut, quite a deep cut. The Brent spreads still are backwardated. The physical differentials that are trading on crudes, benchmark crudes, are still positive, which is, just a clear sign that there is at least enough demand to clear what is there. But I think the indication will be, or the expectation, if we are in a bearish market, is we start to build on stocks, right? That's the generalistic way of saying it. But I think looking more forward, which is what's great about the forward curve and what's great about expiry, is giving us an indication of the sentiment about forward barrels, right? So barrels 2 months forward. And what was it? December barrels. This is the last chance to trade barrels before what we expect to be an increase in OPEC supply in January. I think it's a really key time because later on this month we've got OPEC meeting, like technical meetings, and trying to decide what to do next. And I think what the indication is that, as you say, like it is slipping into more of a bearish tone. But there was still, bullish appetite on expiry yesterday. There was still the appetite to take a lot of the North Sea program, kind of from 110 down to 70 cents. So on the cash spread. So that's the physical diff, right? So even though it was weaker, we still had the appetite from, trade houses to actually take those barrels at those levels. So don't get me wrong. That doesn't mean that it's going to stay there, but they were willing to take it on. So it's just another piece of information. So we've reset kind of, as you say, through the $90 psychological range of Brent, and not completely surprising given, a lot of the blame that was put on the rally from kind of low 80s back up to 90s in the first place was on the back of this geopolitical stuff. That's since kind of as expected as well. People are starting to put that to the back of their minds, given it doesn't look like it's escalating. It's all a lot of rhetoric. So it just kind of feels like we're getting back to where we were 2 weeks ago. And yes, the less bullish narrative, I think I quite like, and you said that before. But Martha, where do we go from here, or in terms of is there any other information about the other macro market that I'm missing, maybe the refinery margins?
Yeah, well, just to add on one more thing about Brent, looking at the OI difference between this time last month, looking at the month to then to the month to now, that was over 100 million barrels higher than the OI for this month. So players are just not as interested in rolling their positions later into the year. We don't have this bullish inspiration anymore, and there is this kind of disparity between the physical strength and the macroeconomic situation, and that means that players just aren't as interested in putting positions on. I mean, even in the CFTC data, the changes week on week, they were like minuscule. People, they just don't have the risk on attitude.
That's interesting. And it always comes back to our view on generally the sentiment in markets is people want to be bullish, right? So they get quite easily hyped. And I guess it is always the legacy belief is there's asymmetric risk, right? At the end of the day, there's technically no limit to what the oil prices could get to, but the cap, generally speaking, should be in like the zeros. But obviously that was tested with WTI very briefly in 2020. But you still know at the end of the day, if we're using the stuff and there's demand, people will generally get more excited about it being, a supply crunch and the world going mad, rather than thinking there's a lot of upside risk to being short and seeing the world kind of diminish its demand and oversupply. I just don't think it's never really that compelling, if you know what I mean. Whereas you do see a compelling argument from the macro traders, investing argument, if it's aligned with the economic argument. So, and particularly the US, I think this time round, the main entrance on the bull side, with the Israel Hamas type stuff, that was predominantly led by the US, I would say, at least from the evidence, at least from the investor side. So it's interesting your point, Martha, about people not being that interested, because I think generally speaking, the US we think it's more of a trading mentality, like the everyday person, like the cliche, like dentist even trades, right? And they want more and more access to this kind of retail trading. And I think they want to get excited about things, but I kind of absolutely see a logic, like, I like what you said, it's at the moment, it's like, well, okay, so fine, so we're not getting that excited about oil because it's now coming off again, and all the hype with Israel, Hamas, it just doesn't look to be feeding into oil, feeding into supply. So do you get short? Well, then it's like, what's the hugely compelling reason to get short? So I think it absolutely makes sense from a sentiment perspective that people are losing interest. But on that note, just to finish this off, like, I think we should start talking more about like OPEC as we get towards the new kind of loading periods in January, or trading. We're now trading January and Brent on the futures. So, what do we think they do next, or at least what do you think the market's thinking given the state it is right now?
It's a very difficult one, because in the past few months the trend has been OPEC. Saudi Arabia has continued extended voluntary cuts, yet at the same time the market is in a very vulnerable state given the geopolitical tensions in the Middle East, the war of Iran, Hezbollah's involvement, the potentially more proxy wars developing in the region. And the World Bank recently, they still believe in the potential $100 per barrel plus scenario, especially if in a worst case scenario.
Was it JP Morgan came out and said 150?
150. Also, the World Bank also mentioned in their quarterly commodity market outlook.
But where did they get the 150 from? JP Morgan?
That's I'm not too sure about that, but the writing was that if
it was an independent view.
The independent view, yes.
Right.
So should there be a 6 to 8 million barrel per day disruption from the Middle East, for example, perhaps exporters like Saudi reducing their production or reducing their exports, then that would lead prices to go from up to between 140 to 157 per barrel. These are just in the worst case scenario. And medium disruption would be 100 to 120. But these are just all hypotheticals. So that's all assuming that the voluntary cuts continue, or the cuts continue even more, rather than returning to what we had before and adding that 1 million barrels per day back online.
I see what you mean. So if there is disruption, you can't actually guarantee that OPEC will come back and reduce their cuts, because they didn't in 2022, right? If anything, they made it worse, like continued to cut whilst all this oil was being taken offline. So that's a good point. But it's just the likelihood of this happening. It just feels very low. And I don't think if you're sitting in a big trading seat with a lot of VAR, a lot of position risk to take, I don't think you're putting it on being long right now. And I actually don't think you're probably thinking short either. I think you're just kind of ignoring it, like Martha said. So what that means for OPEC is, like, I guess it's wait and see for another month before they make their decision. But you would think that if they do start to unravel, this is what people are expecting the differentials are kind of sinking a bit lower, and the refinery margins were looking pretty poor. We could talk about that in a sec, but that seems to have like balanced a little bit with the lower crude. So if they just wait another month, it might look like the market's a bit more imbalanced. Maybe could take a few 100,000 more barrels a day, potentially in January. They'll have to kind of see. But yeah, on that note, Martha, what's the refinery margin situation?
Yeah, so we've seen actually a week-on-week improvement in the European refinery margins and in the Asian ones as well. This is month one, 76-cent improvement week-on-week. And this is a crude-driven improvement. So because of the weakness in Dated Brent, the refinery margin has been able to increase even with the weakness across the products. So we're looking at the diagram, we can see that the largest decrease is in gas oil, which I'll get to in a second. But looking at the fuel oil complex this week, it's actually been really interesting the past couple of days. Coming up to the end of the month, the very low sulfur fuel oil, so the 0.5% barges, has just shot up in the last couple of days. Fundamentally, this tightness is seen in Asia out of Fujairah, and there's a lack of spot supply from the Al Zour refinery, so that's really tightening the availability in the east. And this is kind of coming into Europe because no one really wants to sell before the next month month is rolled into. So we've seen Chinese funds and middle-sized trade guys short the Novdex Singh, and this stopping out seems to be kind of like a herd mentality coming over into Europe. They're really like tightly connected markets, so they always do move kind of in tandem. So
yeah, that's really interesting because I think was it even last week we were talking about fuel being suddenly having its reverse, because for a long time this year is correlated with the OPEC cuts, as you'd expect, the heavy barrels coming out of OPEC translating to a tighter fuel oil market. But suddenly that was reversing, right? We're seeing a lot of people taking profit finally at the highs of the cracks and the spreads. And as you're saying, Chinese funds and middle-sized traders were actually getting short, and they've kind of been caught short now, you think?
Yeah. Just getting it up on Flux, we have the December 0.5 barge crack here. It's a classic sign of a potential squeeze as prices exponentially trend higher. And we also saw the same in the east-west as well, which is up above 60.
Could you widen that out in terms of time? So this is very low sulfur fuel oil. Has it happened in the residual fuel oil market as well?
Yeah, so high sulfur's seen a midweek rally this week as well. And the same kind of thing, but this is being like bought into. It's less like significant on the graph, but it's still pretty.
Yeah, I mean the thing
impressive.
is about residual fuel, it's such an important part of the barrel for refiners because it's always usually a waste product. So the fuel oil swaps market, I mean that's what, when we first started this whole gig, liquidity providing stuff. When we were at Mandara, it was the only desk when we first started because it's such a big OTC market, it's such a big swap market because everyone wants to hedge what they know they're going to lose money on. So if it gets to an attractive enough level on the crack and they can lock that in and they can sell their waste at that level, that they know they can essentially secure themselves so they can not have to worry too much, because if the fuel oil crack dumps like $5-6, it just ruins the whole margin. It's significant. Sorry.
Just looking at the counterparty types for that, we've seen like a great deal of trade house buying.
This is VLSFO again, or
this is in the 3.5.
This is in 3.5. Okay.
Sorry, I'm all over the place. So this is in the front crack, I believe. So we've had just under 300,000 barrels bought from us from trade houses over the past week. Yeah. So there's been like real bullish momentum there.
Okay, no, fair enough. So the heavy part of the product margin has picked up again. So it's more crude than the fuel oil, but at the same time, fuel has obviously helped. Yeah. And gas oil as well, or?
Yeah, so gas oil has been shot. It's had a really, really poor week. It's the largest decrease across the barrel in the refinery margins. So last week we saw the really heavy selling in the spreads and cracks, and there's just not really been any support since. Like the ARA stock levels were reduced by 111 kilotons last week, and that provided like no support at all. They just keep being sold down, and this is all kind of linking back to more kind of fundamental reasons in the weather. It's mild in Europe. People don't have that kind of bullish inspiration of a cold snap. I don't think we have any predicted, not even like in the tabloids. Yeah. So I think people are kind of waiting for that. Here we have the market position looking at the CFTC data. We've seen all of the long players like week after week taking off positions for, between 5 and 10 weeks it must be now, and they're just lying in wait now for a good like winter rally, but it's just not happening yet.
Yeah, I think we should never underestimate that. That's why I love looking at margins, because if you look at them as a whole, you know, profitability going up or down ultimately, and in which grades, like basically light or heavy. And you know, for much of this year it was heavy rallying, light kind of weakening. And it's just gotten to those levels now, gotten to an inflection point where actually the heavier side of the barrel was coming off. I know it's picked up a bit on fuel recently, but the gas oil coming off is like pretty devastating for heavy crude margins. Whereas we are getting the support, and we've been talking about, you know, bullish support on gasoline for a couple of weeks now. It's been the basis of a lot of trade ideas. I think cracks, East West now, spreads. Again, we could talk about that in a bit, but my point is that the naphtha and gasoline rallying, if there's not an incredibly tight market or not a justifiably tight market on the refinery side, you know, they're looking to actively hedge these things, and people are looking to rebalance the margin. So in other words, if gas oil corrects, that allows more room for gasoline and naphtha to rally. Because if the overall margin shouldn't rally, in other words, there's not actually an overall net supply deficit, or that there isn't the belief of that, then opportunistically refineries will hedge, or at least they will, you know, ignore some products and benefit from others. And we've probably had a lot of switching away from light ends, you know, FCC margins being negative, things like that. Ultimately, we clearly have gotten to that point where it got weak enough on the light versus heavy that the market is starting to rebalancing, apart from the fuel oil. So I don't know if from a physical point of view, those physical premiums we're seeing from the situation you're talking about, whether that's short-lived, and if that then goes away, we're now back to a trend. And also from going back to the OPEC discussion, I mean, they're going to be looking at this. So of course they want to know about overall crude levels and how that's being traded, but they know their barrels are more related to fuel and gas oil. And if those markets are weakening and long-term trend weakening, then they know they're not having the overall impact that they're expected to have on a global supply balance point of view. So it could be yet another kind of indication that actually maybe this bearish crude move has more legs in it and has more, you know, potential ramifications for the overall supply and demand, which is what they say they're trying to balance. So right now you'd be looking at that and thinking, like, now you've said it, Martha, like gas oil having a really, really weak kind of period. The economy is not looking too strong, like you said, in Asia. We're kind of getting back to that macroeconomic sentiment being weaker. There's a lot of demand year on year, a lot lower. We're full on gas storage. People aren't worried about power this year. People aren't worried about LNG so much. So what does that mean for gas oil, really, or getting exciting about it? Probably not a lot. So you probably are worried from an OPEC point of view, maybe looking at all those in tandem. But as I say, we've got to kind of see how it goes. But another thing I think that's in the notes is interesting is the Panama Canal. Do you want to talk about that, Vincent?
For sure. So it was 2 days ago, the Panama Canal Authority issued a decree indicating that the booking slots would be reduced for ships transiting through the Panama Canal each day, which will increase the waiting times, as well as further exacerbating existing logistical issues. All of this is because the level of Gatun Lake has continued to decline to unprecedented levels for this time of the year because of less rainfall, because of conditions of drought. And in our market, this has really affected the LPG arbitrage spreads, exceptionally because at the same time, LNG...
US being a huge exporter of propane.
For sure.
So they can't get their exporting ships out, basically.
For sure. I think I believe LNG cargoes get priority over LPG ships as well. So that also plays a factor. So I'm showing on my screen, there was a massive, after this headline came out, there was a massive reaction to it as well overnight. So you could see a lot of a big move in the LST FEIR falling to below.
This is US benchmark versus Asia benchmark propane, basically.
Yes.
And that came off a cliff, those levels, basically because it was a glut forming in the US because it couldn't get it out, and obviously Asia reliant on the exports, so it makes a lot of sense. But that's kind of been priced in effectively, what that seems like. It seems like people are starting to buy the dip now.
Yes, correct. And we can also see the same trend in the other benchmarks as well. So namely affecting the FEI, so the East-West FEI versus NWE, Northwest Europe. So you could also see an initial spike from 130 to almost 190 and then coming off shortly afterwards. So these typically happen after a large headline comes out, people react, and then it could be some short covering flows or an LSE FEI, people stopping out, and then after that there's a spike and then naturally corrects, rebounds in the other direction.
Yeah, this is like almost the same as the geopolitical thing, because I think, especially if you're trading swaps or, you know, more niche futures like propane, if something happens in the prompt, the temptation is to believe, okay, well, you should buy or sell propane right now. But the thing is that a lot of the contracts around the world, if not like most of them, are at least 10 to 30 days forward. Some like NAPFA are like even more, like almost 2 months forward, cargoes that are actually affecting the physical price. So to trade M1, it's like, well, that's next month, and then it's priced, that swap is priced by the month after's physical. So is it really likely to impact, you know, 6 weeks plus physical spot cargoes? And the answer might be yes, and I would assume for the Panama Canal, it's significant enough that it can have an impact on the prompt. But I think in a lot of these scenarios, you know, the physical market is increasingly elastic, right? There's just so much fantastic infrastructure around the world, from like now globally, and it's just improving every day. And it's a lot that renewable market can learn from that, right, and leverage off. But at the end of the day, it just doesn't make sense for these price spikes to be bought into or sold into, depending which contract you're using, unless you really genuinely believe it's going to be affected on settlement. And I think that's what the price action shows to me. It's like a blip and then it goes back. So the more that happens, the more these scenarios repeat themselves. It's a bit like hurricanes. A hurricane, just the threat of it, it's like gasoline cracks have made people's careers, right? People buy gasoline cracks in the summer, they buy the spreads, and they're like, okay, well, the risk reward's great here, because if there's even a hint of talk of hurricane, it's just going to explode. And that worked for like a long time. I think you ever read that book, Secret Club That Rules the World? I've forgotten her name now, but she started up a fund in the end. But she made she was a junior, and I think she expected to make like a few $100,000. She made like 5 million because of this RBOB crack blowing out. And it's like, you didn't know a hurricane was coming. You were just long cracks, and then suddenly exploded because of the hurricane. But then every single year, it's like, okay, but is this, you know, is it genuinely impacting gasoline? After the, you know, hugely damaging hurricanes that we've had in the US, it just seemed to be a lot of noise around them, but not genuinely impacting the infrastructure. And like, for example, Colonial Pipeline, that was genuinely a hacking event that took off real barrels offline, and it had zero impact on the outright price. It had an impact on an arbitrage level temporarily. So I think, as you see, my point is in like, unless these things start to really people genuinely believe that's the oil market or wherever these oil kind of infrastructures are genuinely going to be impacted for a material amount of time, it's not a great trade to just buy into these rumors so much. In fact, the trade almost every time seems to be sell the fact, right? Or at least sell the rally. And I think that's kind of speaking to how not just the physical market being elastic, but the derivative volume and all that. Like, to be honest, it's kind of, I wouldn't say this with the propane because it's a very genuine impact, but I guess some of the geopolitical rallies and some of the kind of, oh, the oil market's moving because of this, and then someone picks up the phone and starts buying because of something random, that is dumb money. Like, we just have to accept that is not what you should do. A, you're too late. B, it's like, is it really going to impact the underlying, and do you really understand why and how? And again, to just finish that off, like, I always go back to, you know, what about 2019 when we had 10 million barrels blown away, literally blown away by a rocket? And then a week later, everything was back to normal. I mean, that is the elasticity of these, you know, strong exporters like Saudi Arabia. Like, they're not going to just let 10 million barrels, you know, just disappear. They're going to bring it back online. They're going to be it's their whole economy, right? And I think that's a lot of the world now. Yeah, impassioned speech. But you see what I mean? Is in like, it's just believing in these hypes, and then it's almost like crypto. Like, if you buy into it and then everyone else buys into it, you then have to sell to the people that bought into it, and that's how you'll make money. Unless you buy something, take it to pricing, and the physical is really impacted. But the chances of that are, you get what I'm saying? Yeah,
I mean, with crypto, or you could say in GameStop.
Whenever I mention crypto, your eyes light up. You're like, what did you say?
No. I know other people who would light up even more. This is very minuscule.
It's the financialization concept, retail trading, GameStop. This is the new age. A lot of people do. This is kind of why I'm saying it, because it's knowing what you're trading, and as the retail trader becomes more sophisticated, like GameStop, that's a very sophisticated trade, a short squeeze. So I think that's what this has got to. You got to turn your attention to this, which again would be my argument that we want to get retail into the space, or like the classic investors and investors into the more niche futures, because you get to reflect your view in a much more intelligent way other than just buying Brent because something. It's like, yeah, but why specifically is that event going to impact infrastructure for a sustained period, which is going to impact the physical, that impacts the financial price? And if those things aren't there, then don't do it, because it's just a hype scenario.
Yeah, I mean, in our commodity markets, it's very much, I mean, the way that price is specifically based on the physical, but in products and benchmarks like Brent, it's more speculative, and quite often, you know, it is very psychological. And I used to think that, okay, the market is a perfect, the stock price, or, you know, price of a commodity is a perfect indicator of supply and demand of what people think. But recently, of course, following the Middle East, you know, the geopolitical tensions, the risk premium, there tends to be, I'm seeing more people questioning that narrative, people questioning that, okay, do markets know actually how to price risk? There's just so much uncertainty. Because we are the market, but the question is, does the market itself really understand the sort of like risks that are happening, and are they able to efficiently price this in? But
you need the benchmarks, you need the system to be equipped to price those in efficiently as well. But that's my point. So it's like you're buying propane. Actually, it's a bad example because it's a genuine event that had a genuine impact on price in a justifiable way. But say a geopolitical event, it's like you're buying, but why are you specifically buying? Well, if you say, because I know that pipeline that links from here to here is going to be impacted and it's going to be this amount of barrels offline, okay, fine, then you need a contract that reflects as close to that pipeline as possible. And the contract that's traded needs a price reporting agency that can demonstrate to you, yeah, we use cargo prices every day from that pipeline to then settle the price on that basis. Therefore, correct choice. This is the right contract to trade. That you need to go and look at the evidence, is what I'm saying. Did you want to say? Yeah.
Yeah, we're talking about hurricanes, and just exactly to your point. So say like a hurricane hits the US, obviously it depends what coast it's hitting at, but if you just like buy WTI like flatty, then that's going to actually suffer because the TI spreads like get sold down in a hurricane. I know that we did studies on hurricanes because we do the Hurricane Watch, but like Hurricane Ian that happened a few years ago, that basically hit exactly where Mars is like drilled, and exactly Mars. Yeah. And so like that, the Mars TI diff like went crazy, but the TI like time spreads absolutely got smashed down because they weren't able to do any exporting because obviously it's landlocked. So like if you were just to, as you say, buy the simple like flat price, that would be, you know, not
so it's a lack of contract choice maybe for the people who want to, and before people say, yeah, but retail, you know, it's a huge part of the market movement. At least on the WTI and Brent. And I think if they were given more access to these kind of things that we're talking about, you know, an arbitrage, what do we mean? LST versus FEI, US propane versus Asian propane. Do you think an average investor has heard, or a retail investor has heard of that? No, but they should have. They should be given the opportunity to trade that because they want to reflect a view based on the Panama knowing it's going on. So you just need to give them that access. But then I guess what I was adding to that layer is you then also need to make sure that just because a contract says we are US propane, you're like, yeah, but what US propane? Like you just mentioned with the WTI, you're trading Oklahoma crude. So therefore, when a hurricane comes, they can't export out of Oklahoma into the Gulf Coast where the refiners are. So it's bearish. It's like, what? You know, you think that's so mental. But like, that's the whole point of these contracts. You want to make sure you know you're trading what you're trading. So anyway, that's probably enough of that. But it's a good point, and we'll continue to say this narrative, right? And hopefully, we're involved in the expansion of the retail game. But just as we wrap up, trade ideas. So we're saying gasoline East West, Martha. Is that the Q2, right? That you were on LinkedIn talking about?
Yeah, I was on LinkedIn talking about it. I thought
no, still Vincent's Thunder.
So yeah, so we're
No
collaborating on
way.
this.
Collaborating.
We're collaborating.
Okay, go on.
It's a collaboration between two of us in the research team. So the trader there, Martha mentioned, you've probably already seen it on LinkedIn. Long Q2 gasoline east-west. So it is a trending trade. So as I have on my screen here, this is the Q2 24 contract. Prices have reset higher recently off the back of weaker European gasoline, but since then, since October, prices have come off a lot, but we are seeing a slow reversal. The market has found the floor, and gasoline, the 92, the Eastern Complex has seen some strength recently. Prices also look historically low, with the exception of 2022 in this tenor. And RSI recently fell into oversold territory and has just come out. Looking at Bollinger Bands as well, there's also room and space for prices to go up. And especially interesting in the 92 crack, there's been a lot of buy-side interest. We've seen open interest around 2.5 times their 5-year historical average, so indicating a lot of market interest. Our dashboard showing it's a lot of speculative length coming in this part. So
Do you have any of this on there?
indeed, yes. So to answer your question, Greg, yes. So putting up the counterparty dashboard on the east-west gasoline Q2 tenor, we're seeing a lot of buy-side interest recently. So net positioning almost 150k by trade houses, some buying from refiners as well. So there's definitely market appetite to go in here, and also, but turning to our COT dashboard, looking at the 92 crack in the Q2, there has been overall substantial buying interest, with the market still getting longer. And looking at where I'm hovering, open interest, also the dark blue line substantially higher than light blue, showing a lot of interest for this time of the year. So overall, combining these factors, we believe there's good risk reward in going long in the Q2 east-west. So as a trending trade, we did set a stop loss of minus 680 per barrel, which actually sits outside the trending range.
Where is that? Could you put that on the graph? So 680 is around there, is it?
Yes. So
Okay, so you basically say, so we've come out of the dip, and as you say, the RSI was briefly in oversold. So that's now coming back into kind of the mid-range alongside genuine buying interest in 92 and East-West itself. So you just got basically people starting to focus on this. We're back out of the kind of sideways trend and going into a bullish trend. And you're trying to say we're at the early stage of that cycle, right? And your open interest graph, because it's Q2, the open interest might be a lot higher than the 5-year average right now, but it's still got a long way to go until it gets till it gets to its capacity. So that's a decent. All those things, to me, I think you're right in saying it's the start of a trend, right? Or at least it's got the opportunity to be the start of a trend. So it could take a lot more buying flow. We can get a lot closer to that cap of open interest we'd expect before you'd look for the trend to be over. So that's pretty compelling. Yeah, nice one. And just on the stop though. So again, you've made the claim it's a trending trade. So I get your point, but it's the very beginning of a trending trade. So it feels, I would say, just using the completely like the historical price action, you want to be underneath the recent volatility. That's essentially what you're saying. It's a relatively tight stop, because I guess if it does move back down to the 680, that is certainly the end of the beginning of a bullish trend. So I think that would be testing your hypothesis, and I think that would be a good thing to exit, because obviously it's been tested. So you would expect probably, I don't know, something else has happened, like new selling flow you weren't expecting. But from a fundamental point of view or sentiment point of view, why do you think people will continue to buy the East-West given the China situation and all that?
I think the China situation is more. I think with gasoline, with the refined products, it's less macro sensitive, because there was a reaction to, for example, recently last week there was headlines of China potentially reducing the gasoline exports going into the end of the year. So that's a bullish factor, as well as
So more of a supply story than a demand story.
Supply story, and for most it's refinery outage as well. So these factors pointed to a rally in 92 spreads, and there was some buy side interest, but also we have seen deferred interest as well. So
just to finish off the trade graph though, because it's really good work. But I just wanted to, could you go back to the graph? Okay, so the other thing is the timing element, right? So we have got a pretty, it's definitely reset higher in the long run. So, and you're basing this recent trend moving into bullish on quite a short time frame. So I guess using the volatility around where it's been, the kind of timing on this trade is probably a couple of weeks, or is it more than that?
I believe a couple weeks, give or take.
Yeah, because if you're going to make it longer than that, you're kind of looking at a long overall trend. And if anything, we're definitely in a sideways trend if you're looking at it from a kind of monthly basis. So this is certainly a more short to medium term trade, right? And I guess that if you're not seeing the continuation of the trend in the next couple of weeks, it's another reason you'd probably exit, because it's just not happening as you'd expect it in the time frame you expected it. Whereas if it does start to perform, what are you starting to think? Like if you want to maximize your risk reward, then you would probably let the time go on if the trend was going on. So kind of become like almost a volatility stop over time. If it wasn't continuing that trend as you go beyond 2 weeks, then that's probably a good reason to be like, look, within the time frame I was expecting, it's probably time to wind down this trade. You see what I mean?
Yeah, for sure. That's a good point. So yeah, time frame's important, but also let's say if it does start trending higher, then perhaps we would set a rolling stop as well. So maybe just like a constant like 50 cents stop.
What, ratcheting up?
Ratcheting up, yeah.
From the 680, keep ratcheting it up, every week?
Yes, as price trends, if price trends higher. But otherwise, if it goes down, then it would go against our hypothesis, and that would be a good time to exit a trade.
Cool. All right, nice one. Hopefully more of that coming, because I love getting into the weeds of a trade. I think that's the added value. So good stuff there. All right, guys, we'll leave it there. And for listeners out there, again, please interact if you can with us. We really appreciate it. And again, like, share, subscribe. That would really benefit us. So thanks for listening, and speak to you next week.